and private banks are performing very well, especially benefiting from the rate environment. So revenues up 25% and 11% respectively. Businesses that are more tied to the financial market environment, for us, investment banking and asset management, a little softer, down 11% and 6% respectively. But we think both of those performances are quite respectable in the environment that we've been in. And in the case of investment banking, compares to just an outstanding second quarter of last year, which, as you recall, was a very volatile environment, and therefore the markets businesses were able to perform very strongly. We think that at down 10% in our FICC markets business, we're today in the middle of the pack, probably a little better than the middle of the pack these days. We think the environment looking forward to the balance of the year should remain about the same, perhaps improve slightly for those businesses. So we're optimistic about the path forward.
You mentioned indeed FICC revenues are down by 10%. What else caused this weaker performance? It's not just a question of lower volatility in this quarter, is it?
Well, it is the theme that we were calling for already late last year, which was that 23 would see call it a normalization of the macro product set, which for us is FX, rates, emerging markets. And we needed to see and expected to see a recovery from relatively low levels of revenue in what I'd call a more micro product set. So credit, particularly, but also in the corporate finance areas, M&A and equities. That micro improvement we have seen in the credit-related areas, and so they're up within our businesses. The recovery of a corporate finance product set's been a little slower than we might have liked to have seen. But that rotation is one that we were expecting and we're seeing play out.
Now, when it comes to costs, we've seen a huge increase in this part of the balance sheet. Given that we are now operating in an environment of higher inflation as well, what's the outlook for costs? Do you expect this to continue to go up in the coming months?
Well, we've been working on a very comprehensive cost agenda. We laid out March 22, and we actually upped the target that we had for cost savings based on, or I'll call it organic initiatives, from at the time 2 billion to now 2.5 billion. And Sylvia, to your question, that's what we're doing to offset the impact of inflation, but also business investments that we are making, both to support future revenue growth and to invest in our technology estate and improve our controls. So for us, it's a balancing act between delivery on the expense objectives and some of those inflationary impacts. In recent quarters, we've succeeded very well. We've delivered on our guidance of costs essentially flat to the fourth quarter of last year. That's something that we're aiming to continue. We feel like the progress we're making in those expense initiatives is considerable and accelerating. We think about 1 billion of that, initially 2 and then 2.5 billion, has either been delivered into the run rate or will be based on actions that are now completed. Our run rate, is something we're continuing to work towards that flat level. Towards the end of the year, we'd probably see that increasing perhaps to 5 billion as we bring on Numis as part of the company and close on that transaction and see some of the front office investments that we've been making come through. But the overall trajectory for us of delivering operating leverage based on revenue growth and relatively flat expenses is one that we feel quite confident about.